In the dynamic world of global finance, a seismic shift is underway that has captivated both financial experts and the general public alike. At its core, this shift revolves around the unraveling of the bond market, a linchpin of financial stability worldwide. The implications of this transformation are profound, driven by a mounting debt crisis that spans nations and generations. In this exploration, we'll dissect the extraordinary events that have transpired in recent months, including inflation shocks, surging interest rates, and unprecedented government borrowing. Join us on this journey as we uncover the narrative of the bond market's most significant upheaval in history. In the latest flow-show note from Bank of America's resident bear, Michael Hartnett, a remarkable chart caught our attention. It reveals that the bond market has experienced its most significant bear market ever, with a record 25% decline over the past 28 months since its peak in July 2020. This revelation is particularly striking considering that Bank of America's historical data spans an impressive 236 years, dating back to the founding of the United States. It serves as a stark reminder of the financial turbulence brought about by an unexpected inflation shock and a rapid rise in interest rates. Adding to the concern is the alarming pace at which the U.S. government is accumulating debt. In just 18 days, the government increased its debt by over $500 billion after surpassing the $33 trillion mark, a rate of debt accumulation that would have taken until March 1975 to achieve in the past. The combination of massive deficits and a 5% interest rate is posing a significant challenge. Previously, when the Federal Reserve maintained zero interest rates and purchased substantial amounts of treasuries, these issues were less noticeable. However, at the current interest rate, the government's debt burden is escalating rapidly, potentially outstripping demand for the world's safest investment. Ed Yardeni, founder of Yardeni Research, aptly points out that the volume of debt has become overwhelming. Consequently, yields on 10-year Treasury bonds are rising to their highest levels in 16 years, with investors demanding discounts to purchase the debt. The withdrawal of central banks worldwide from the U.S. bond market has empowered traditional financial players, including banks, hedge funds, and insurers, known as the bond vigilantes. These forces are driving bond prices down, pushing yields up, and sending a clear message to Washington about the need to address the deficit and inflation. It's important to note that this situation doesn't imply a U.S. default on its debts. The concerns are more about the impact on companies and consumers, as excessively high and rapid yield increases could potentially disrupt the economy. A key threshold to watch is 5% on the 10-year bond, as exceeding this level could significantly increase the chances of recession. This bond market turmoil is historic and has drawn comparisons to past financial crises, including the dot-com bust and the market turbulence preceding the 1987 stock market crash. The repercussions are extending into other asset classes, with corporate bonds, the dollar, and even oil markets experiencing effects. What makes this period even more shocking is that it marks a departure from the years of stability orchestrated by the Federal Reserve in the bond market. The era of rock-bottom interest rates, which seemed like the new normal following the 2008 financial crisis, is being upended by various economic forces. These include global warming, the shift to green energy, deglobalization, demographic changes, and the ongoing issuance of government bonds. In essence, we are entering a world where bond traders, not the Fed, hold more sway, and everyone, from consumers and corporate leaders to policymakers, must confront the reality that the era of easy money is ending. While central banks may seek a return to the old normal, the consequences of doing so are daunting, as it could wipe away a significant portion of the stock market gains since 2009. Yet, the alternative, a massive global depression and potential social unrest, is equally untenable. In this precarious balancing act, the Fed faces the challenging task of navigating both inflation and the risk of a catastrophic capital market collapse. While it may appear amusing to some, the ultimate choice is clear. The Fed, an unaccountable institution owned by private banks and financial interests, is expected to prioritize maintaining market stability, likely leading to a new inflation target in the U.S., possibly even exceeding 3% in the coming years. In this rapidly changing financial landscape, the bond market's historic turbulence serves as a stark reminder of the delicate balance between economic stability and fiscal responsibility, leaving us to ponder the uncertain path that lies ahead.